Greetings and welcome to the Yeti Holdings fourth quarter 2020 earnings conference call. At this time, all participants are in a listen-only mode. A question and answer session will follow the formal presentation. If anyone should require operator assistance during the conference, please press star 0 on your telephone keypad. As a reminder, this conference is being recorded. I would now like to turn the conference over to your host, Tom Shaw, Vice President of Investor Relations.
Good morning, everyone, and thanks for joining us to discuss Yeti Holdings' fourth quarter and full year 2020 results. Before we begin, we'd like to remind you that some of the statements that we make today on this call, including those statements related to the impact of the COVID-19 pandemic on our business, may be considered forward-looking, and such forward-looking statements are subject to various risks and uncertainties that could cause our actual results to differ materially from these statements. For more information, please refer to the risk factors detailed in our most recently filed Form 10-Q and the Form 8-K filed with the SEC today, along with the associated press release. We undertake no obligation to revise or update any forward-looking statements made today as a result of new information, future events, or otherwise, except as required by law. During our call today, we'll be discussing certain non-GAAP measures pertaining to completed fiscal periods. Reconciliations of these non-GAAP measures to their most directly comparable GAAP measures are included in the press release issued this morning, as well as in the supplemental reconciliation, both of which are available in the Investor Relations section of the Yeti website. We use non-GAAP measures as the lead in some of our financial discussions, as we believe they more accurately represent the true operational performance and underlying results of our business. Today's call will be led by Matt Reinches, President and CEO, and Paul Carboni, CFO. Following our prepared remarks, we'll open the call for your questions. And with that, I'll turn the call over to Matt.
Thanks, Tom, and good morning, everyone. 2020 was an incredible year for Yeti, punctuated by a very strong fourth quarter. As we look back at our original 2020 full-year outlook, we exceeded the high end of our net sales forecast and the high end of our adjusted EPS. We're proud of this performance and execution given the constant series of challenges we successfully addressed throughout 2020. I would be remiss to not take a moment to acknowledge the passion and dedication of our team at Yeti, plus the amazing support of our partners and customers throughout the year. At the same time, our hearts continue to go out to those within our communities that are suffering through the hardships of the ongoing social, economic, and pandemic challenges. Before getting into the details of our results and our strategic priorities, I want to highlight two themes we believe are central not only to our success in 2020, but also how we will continue to resonate with customers over the long term. This starts with our brand's innate ability to connect with customers in meaningful ways. For years, we've been part of the shift to a more active lifestyle and a greater appreciation for outdoor activities and recreation. The pandemic furthered these behaviors, including a well-documented increase in vacations closer to home. As a brand that lives to deliver performance, durability, and versatility across all of our products, we are positioned well at the intersection of these trends. As the world changed dramatically during the pandemic, many of the observed consumer shifts I outlined gained further traction, supporting the tremendous results we are sharing here today and building upon our legacy of growth. However, a world of distancing also meant that many other activities with high Yeti relevance were curtailed or eliminated. Many events and gatherings, including weekend tailgating, backyard barbecues, standing on the sidelines at sporting events, or something as simple as a hot drink for a morning commute, were disrupted. Moving forward, we expect the traction of outdoor and active pursuits to endure. At the same time, our brand is uniquely positioned as people begin to return to certain elements of work life, social gathering, and travel further afield. Over the past 5 years, we have adapted our business to drive impact in a rapidly evolving digital consumer environment. Supported by our breadth and depth marketing strategy, which has been a consistent hallmark of our brand engagement and awareness push, we believe has been a true differentiator for Yeti. As we have previously communicated, we evolved to even stronger digital engagement and reach in 2020. The success of this transition, as well as other lessons from the pandemic, have helped inform and prioritize how we will invest across our strategic priorities. Most notably, you will see an added focus this year in digital brand and product storytelling, product development, data analytics, e-commerce, and our international infrastructure. We believe this focus will help Yeti build upon its leadership position in the market and ultimately capitalize on our global potential. Now turning to our results. Unwavering customer demand and incredible execution by our team resulted in fourth quarter net sales growth of 26% and delivered full year growth of 19%. D2C continued to lead the way, growing 46% for the quarter and 50% for the full year. Wholesale posted a 6% increase for the fourth quarter, and despite the massive channel disruptions throughout the year, ended the full year down only slightly. Product strength was balanced between coolers and equipment and drinkware for the quarter, with both posting approximately 20% growth for the full year. Finally, our international business, which remained at a Yeti high 7% for the second straight quarter, delivered 81% growth and ended the year at 6% mix, exhibiting growing demand and even in the face of large-scale disruption to retail partners outside of the U.S. Equally as strong as the top line, our adjusted operating margin expanded 440 basis points in the quarter, highlighted by gross margins approaching 60%. Similarly, full-year adjusted operating margin expanded nearly 500 basis points to reach 20.5%. These results yielded adjusted EPS growth of 70% for the quarter and 76% for the year, while also supporting the voluntary debt paydown of $100 million during the fourth quarter, resulting in our year-end cash balance of $253 million. A strong and consistent performance top to bottom. Now shifting over to our strategic growth priorities, which have remained consistent since our IPO in 2018 and will continue to guide our focus and our investment in 2021. First, our fourth quarter brand and product storytelling efforts were perhaps our strongest, most consistent, and most integrated, culminating in Yeti as a holiday must-have. Supporting these year-end efforts, in November, we broadened distribution of our Yeti Dispatch Magalog to over 1.8 million homes, while also extending those stories digitally to expand reach and duration of the impact. As an example, we developed ambassador content that was featured in our Wild Thanksgiving digital campaign, which was also highlighted in a print copy of the Dispatch. We also reinforced the overall Yeti brand through focused strategic television placement in key sports and entertainment slots in Q4, alternating between a product showcase and a Yeti brand spot. Throughout the quarter, we continued to look for ways to impact our community. We supported incredible organizations such as Captains for Clean Water, Black Outside, Billion Oyster Project, Heroes and Horses, Conservation Alliance, the Nature Conservancy, the Lee Initiative, Southern Smoke, Outreach Alliance, and Memphis Rocks. In November, the limited edition Veterans Day tumbler we introduced to benefit Folds of Honor and Lieutenant Colonel Dan Rooney's mission of educational scholarships for families of fallen and disabled service members quickly sold out and raised $50,000 for this worthy cause. As we shift to 2021, we have 3 areas of focus for our brand. First, we will continue to build our breadth and depth strategy for both the digital and offline world, primarily created by our very talented in-house team. This is a key pillar of consumer engagement and acquisition, with us alternating between brand and product stories. Music is a great example of a reach platform where we are focused on expanding our audience and driving a unique Yeti form of engagement. For example, we continued our work with highly talented artists to create curated Spotify playlists, including the Beastie Boys, Leon Bridges, and most recently, the Foo Fighters. Expect additional impactful initiatives here in music and our other communities as we move throughout the year and bring expansive and creative reasons to connect with Yeti. Another focus will be to continue leveraging the depth of our existing U.S. market efforts while also establishing our international roots. This includes the inaugural season of Major League Soccer's Austin FC with Yeti as their jersey sponsor, as well as supporting our partners such as USA Climbing and surfer John Florence at what we hope will be the Tokyo Olympics this summer. It will also mean expanding our global roster of ambassadors and partnerships, digital brand building, and developing international focused content and stories. Finally, we have a thoughtful approach to sustainability in Yeti. This begins with acknowledging what we are already doing, driving a strategy that is impactful, and communicating appropriately across our channels and product. More to come on this journey, but to be clear, we expect ESG to continue to be an integral part of the Yeti business, brand, and our overall story of durability. On the innovation side, we saw broad-based strength from both new products launched in 2020 as well as our legacy products. Our successful fourth quarter was led by sustained demand for coolers, even as inventory remained challenged across our channels due to COVID-related supply disruption. Growth in drinkware was excellent as receptivity to our expanded Coaster line, continued interest in our bottle offerings, and ongoing vitality across our both new and existing tumblers continued. Importantly, we also earned product recognition and validation across a wide range of media. Men's Health highlighted the Roadie 24 Hard Cooler as the best cooler in its 2020 Outdoor Awards. Gray's Sporting Journal honored the Loadout Go Box in its best accessories list. And Time Magazine selected the Yeti V-Series cooler as one of the 100 best inventions of 2020. These accolades not only recognize our latest innovations, but also support continued healthy consumer discovery across our portfolio. One way we extended product vitality in existing Yeti products was by highlighting favorite heritage picks through our Q4 Gear Garage Finds campaign that featured limited quantities of discontinued items or colors. In new offerings, we added the popular ice pink color to the 10-ounce tumbler and introduced our second Yeti Presents coffee table book with Wild Sheep. As part of our new sponsorship of Austin FC, we also offered their official club jersey on our website. Combined with the aforementioned brand and product initiatives, there was no shortage of energy around the Yeti innovation during the quarter. As we continue into 2021, our product lineup will showcase investment in product, continued expansion through color and line extensions, elevated go-to-market product storytelling, and category expansion. This holistic approach will support the vitality of demand we expect this year. Let me give you a few details. We are standardizing our innovative mag slider lid solution across our drinkware lineup. This includes both replacing standard lids that historically came with a product, such as our lowball, and also adding lids that were sold separately for a product, for example, the wine tumbler. We're also in the process of transitioning many of our lids to utilize a new material containing 50% post-consumer recycled content. While adding to our product costs, we believe these types of actions make an impact, continue to deliver value to our customers, and sustain our premium positioning. We will also debut 3 new colors: Aquifer, Prickly Pear, and Granite. In drinkware, we will also add line extensions that reflect the customer demand for larger capacity, single-person drinkware. And next week, we will launch a new collection of bags consisting of backpacks, duffel bags, and wheeled luggage. Originally planned for the second half of 2020, we postponed the introduction and believe now is a more optimal time to introduce our Crossroads collection to the market, given the continued focus on short excursion road tripping and the expectation of buildup to traditional travel and daily commutes. Each piece in the collection has been constructed with durability, performance, and design in mind. From our material choices to accessibility, storage, and comfort, the collection is perfect for weekend travel or adventures far from home. Leveraging our prior learnings in this category, we see a tremendous opportunity to offer a collection positioned at the center of premium, outdoor-ready, and daily use. We are launching D2C only as we build into the product family, build awareness, and ramp our supply chain through 2021. Shifting to our omni-channel strategy, 2020 was a strong year for our direct-to-consumer business, with a record 53% mix for the full year, continuing the shift from less than 10% D2C only 5 years ago. This underscores the focus and importance we have discussed of meeting customers where they want to shop. Yeti.com showed outstanding growth, extremely strong, consistent price integrity, and execution in the face of holiday small parcel capacity challenges. Our team did a phenomenal job focusing on end-to-end service this year, including our work to position inventory, balance our distribution center productivity, and secure carrier capacity. Our corporate sales business also had a great quarter. Throughout the pandemic, we've seen Yeti remain a go-to choice for employee engagement, corporate rewards, and brand partnerships. At the same time, we continue to succeed in our targeted efforts to engage corporations through our outbound, focused on sustainability messaging. At wholesale, even with a challenging inventory position, our wholesale partners did a phenomenal job addressing customer demand as we work to replenish supply. Entering 2021, we have visibility into restock needs and the expected replenishment cycle across accounts as we move throughout the year. We remain encouraged as our wholesale partners continue to evolve their own models, leveraging digital to drive increasing relevance with customers while brick and mortar rebuilds traffic. Going forward, we will continue to invest to build broad channel strength. At Yeti.com, this includes recent hires to drive expertise and discipline across digital and analytics, further developing our consumer data platform, investing in our enhanced e-commerce shopping experience, and continuing to drive seamless customization. In corporate sales, we will prioritize executing against a strong order pipeline and optimizing our service structure to be even more productive in our sales efforts. At Yeti Retail, we remain focused on implementing strong operations across our young fleet of 8 stores while evaluating very select openings in the back half of the year. Finally, on wholesale, our clear focus will be on thoughtfully getting inventory repositioned, fully rebuilding Yeti merchandising on the floor, and working with our partners on the success of their overall omni-channel efforts. On the international side of the business, we continue to build upon momentum of our international sales, with mix growing from just 2% in 2018 to 6% for 2020. As the largest driver of our international business today, Canada showed strong growth despite significant lockdowns and restrictions that impacted the local wholesale market. Our Canadian D2C business grew triple digits as we built awareness and executed on strong demand. Across the rest of our markets, Australia continues to raise our expectations with triple-digit overall growth in the quarter. In Europe and the UK, we continue to see receptivity build with stronger than planned D2C, offsetting the impact of our disrupted wholesale rollout this year given the pandemic. We are putting additional capital and resources behind our international efforts in 2021 as we look to extend D2C and targeted wholesale strategies across each region. In Canada, our focus will be on demand creation and inventory resets. In addition, we are putting a heavier focus on D2C execution and are excited about the prospects of our National Hockey League licensed drinkware launch. In Australia, we are adding resources to drive additional brand awareness and make a push deeper into the large urban markets. In Europe and the UK, we're developing new local language e-commerce sites and accelerating our wholesale push beyond the approximately 125 doors at the end of 2020. In Asia, we are focused on unlocking growth in Japan from the limited wholesale reach we have today, while also setting the infrastructure to support additional Asian markets. Holistically, we believe that international remains a massive opportunity for the brand, and we are more formally aligning our organization to drive our potential here. As I hand the call over to Paul to review our detailed results and outlook, I want to again thank our Yeti team for the incredible work, resilience, and dedication that made 2020 the success that it was. Moving forward, we will undoubtedly need to address unknowns that will have varying degrees of impact on the economy, consumers, and those associated in some way with our brand. What is never in doubt is that we take any challenge as a chance to get better and strengthen our business. We remain incredibly optimistic about the opportunity for 2021 and the long-term sustainable growth opportunity of Yeti. Thanks again, and now I'll turn it over to Paul.
Thanks, Matt, and good morning. Before providing the full details of the quarter and fiscal year, let me begin by also adding my thanks for the incredible resolve of our team during a truly one-of-a-kind year. Their efforts were instrumental in delivering the incredible results for the year, including 19% net sales growth, adjusted operating margin expansion of 490 basis points, 76% adjusted EPS growth, and the voluntary paydown of $150 million in debt. Now on to the fourth quarter. Net sales increased 26% to $375.8 million, compared to $297.6 million in the prior year period. This growth was on top of the 23% increase posted in the year-ago period. Results were above our expectations and reflect the continued strong demand for the brand. For the full year, net sales increased 19% to $1.09 billion, an incredible achievement while looking back at our initial full-year outlook of 13 to 15% sales growth. As previously discussed and contemplated, both the fourth quarter and full-year results include the impact of the 53rd week, which added approximately $7 million to net sales for both periods. By channel, direct-to-consumer net sales grew 46% to $217.8 million, compared to $149 million in the same period last year. Overall, DTC reached a new quarterly high of 58% of net sales for the period, compared to 50% in last year's period. DTC performance was driven by strength in both our coolers and equipment and drinkware categories. We were encouraged to see all DTC channels posting at least 20% growth across Yeti.com, the Amazon Marketplace, Yeti Retail, and corporate sales. For the full year, DTC net sales increased 50% to $580.9 million, representing 53% of the overall sales mix, which increased from a 42% sales mix last year. While not an update we will provide quarterly, the fiscal 2020 mix within DTC consisted of approximately 50% from our global Yeti websites, high 20s from the Amazon Marketplace, approximately 20% from corporate sales, and the remaining low single-digit portion from Yeti Retail. Wholesale net sales increased 6% to $158 million, compared to $148.7 million last year. Wholesale performance was driven by balanced growth across both our coolers and equipment and drinkware categories, despite ongoing inventory constraints in the channel. Full-year wholesale net sales decreased 3% to $510.9 million, primarily driven by the effects of the COVID-19 pandemic on temporary store closures during the first half of 2020. By category, drinkware net sales increased 23% to $235.7 million, compared to $192 million last year. Demand was strong across our drinkware portfolio, and we continue to see momentum from our more recent introductions, led by the expanded and improved Colster lineup and updated bottle styles with chug caps. In addition, the expansion of our customization capacity allowed us to better capitalize on the tremendous demand for personalized products by both consumers and corporate accounts. For the year, drinkware grew 19% to reach $628.6 million. Coolers and equipment net sales increased 31% to $134.3 million, compared to $102.3 million during the same period last year. Demand across our coolers business remained strong despite limitations on inventory availability, particularly in hard coolers. The ongoing success in our outdoor living category also gives us confidence in our broader category expansion opportunities in 2021 and beyond. For the full year, coolers and equipment net sales increased 21% to $446.6 million. Gross profit increased 39% to $224.8 million, or 59.8% of net sales, compared to $162.3 million, or 54.5% of net sales during the same period last year. The 530 basis point year-over-year expansion was driven by the following favorable impacts: 210 basis points from product cost improvements, 200 basis points from channel mix, 60 basis points from lower tariffs, 60 basis points from lower inbound freight, and 80 basis points from all other impacts. These gains were partially offset by 80 basis points from higher inventory reserves, including the unfavorable impact of recall-related expenses associated with the previously announced voluntary travel mug recall, as well as new product transitions. Full-year gross profit increased 32% to $628.8 million, expanding 560 basis points to 57.6% of net sales. Adjusted SG&A expenses for the fourth quarter increased by 30% to $140.3 million, or 37.3% of net sales, as compared to $108.3 million, or 36.4% of net sales in the same period last year. Variable SG&A expenses increased as a percentage of net sales by 140 basis points, driven by the shift in channel mix towards our faster-growing and higher gross margin DTC channel, primarily related to outbound freight. Non-variable SG&A expenses decreased as a percentage of net sales by 50 basis points, driven by the overall strength of the company's top-line results. Full-year adjusted SG&A expenses increased 22% to $404.5 million, increasing 70 basis points to 37.1% of net sales, driven by variable expenses increasing 210 basis points, and partially offset by non-variable expenses decreasing by 150 basis points as a percentage of net sales. Non-variable expense leverage was driven in part by our strong top-line results, as well as cost curtailment efforts implemented during the second quarter in reaction to the onset of the pandemic. Adjusted operating income increased 57% to $84.5 million, expanding 440 basis points to 22.5% of net sales, compared to $54 million, or 18.1% of net sales during the same period last year. Full-year adjusted operating income increased 57% to $224.3 million, expanding 490 basis points year over year to 20.5% of net sales. Our effective tax rate was 23.1% during the quarter, compared to 29.7% in last year's fourth quarter. For the full year, our effective tax rate was 24.1%. Adjusted net income increased 73% to $65.2 million, or 74 cents per diluted share, compared to $37.8 million, or 43 cents per diluted share during the prior year period. Full-year adjusted net income grew 79% to $164.2 million, or $1.87 per diluted share. Now turning to our balance sheet. As of January 2nd, 2021, we had cash of $253.3 million, compared to $72.5 million in the year-ago period. Inventory declined 25% to $140.1 million, compared to $185.7 million during the same quarter last year, a sequential improvement from last quarter, but slightly below plan given our stronger top-line performance. We expect to continue our supply chain efforts to rebuild in-stock levels throughout the first half of the year. Total debt, excluding unamortized deferred financing fees and finance leases, was $135 million, compared to $300 million in last year's fourth quarter. During the quarter, we made principal payments of $103.8 million, inclusive of a $100 million voluntary prepayment. At the end of the quarter, we were in a net cash position as cash on hand exceeded total debt. Now turning to our full year 2021 outlook. I would like to provide more color than our historical practices, given the unique comparisons from 2020. we expect full-year net sales to increase between 15% and 17% compared to fiscal 2020, above the high end of our long-term target and supported by both our innovation pipeline and ongoing work to replenish our wholesale channel. As a reminder, fiscal 2021 is also comparing to the 53-week period in fiscal 2020. Within the sales outlook, we expect wholesale growth to be above our long-term target of up mid-single digits as we continue to focus on driving improved stock levels across the channel. We also expect growth in our direct-to-consumer channel will continue to outpace wholesale for the year. By category, we expect coolers and equipment to slightly outperform drinkware. Looking at cadence, we expect the highest growth rate during the first quarter, with double-digit growth in each of the following quarters. On the margin side, we expect flat gross margins from the record 57.6% level, which reflected nearly 600 basis points expansion in 2020 and over 800 basis points expansion since 2018. Despite the continued favorable impact from channel mix, our ongoing efforts to drive product cost improvements will be more limited in 2021 for two reasons. First, we are taking strategic action to invest back into our products to further elevate our value proposition, enhance the consumer experience, and widen the consideration gap. A great example is our decision to add mag slider lids across all our drinkware starting in 2021, effectively upgrading approximately 20% of our drinkware assortment. In addition, the strengthening of the Chinese RMB since last summer will factor into our product cost negotiations. From a cadence perspective, we expect positive year-over-year gross margin trends during the first half of the year, some contraction during the third quarter, where we face an exceptionally strong comparison from the prior year, and expect fourth quarter to be flat to the prior year period. In SG&A, as we have discussed in the past, we have planned SG&A in 2021 growing slightly faster than sales. We expect full-year variable expenses tied most directly to our faster-growing and higher gross margin DTC channel will grow slightly faster than total sales. We also expect full-year non-variable expenses to be flat as a % of sales as we continue to focus on our strategic growth initiatives, investing behind our current momentum to support our sustainable long-term growth and strengthen our competitive advantage, including areas such as data analytics, international, and product development. The combination of these factors will drive the highest year-over-year expense growth in the second quarter, with growth rates then easing throughout the balance of the year. Overall, we expect a slight decline in adjusted operating margin to approximately 20% for the year, following the nearly 500 basis points improvement we generated last year. Adjusted operating margin expansion in the first and fourth quarters is expected to be offset by contraction in the middle quarters, given the expense factors I have just outlined. Below the operating line, we expect an effective tax rate of approximately 24.5% for fiscal 2021. Based on full-year diluted shares outstanding of approximately 88.6 million, we expect adjusted earnings per diluted share to grow 13 to 15% to between $2.11 and $2.14, compared to $1.87 in fiscal 2020. From a timing perspective, we expect adjusted earnings per share growth during fiscal 2021 to be heavily weighted to the first and fourth quarters. We expect an increased level of capital expenditures of $55 to $60 million, primarily reflecting technology upgrades to support our business growth, including continued enhancements to SAP, website optimization, and enhanced data analytics capabilities, as well as spending to support our commitment to new product development and innovation. In summary, I'd like to reiterate the broader themes that Matt mentioned at the beginning of the call. First, we believe Yeti is well positioned to capitalize on changes in customer behaviors. Recent trends that have been accelerated during the pandemic, which I would broadly categorize as outdoor pursuits, are expected to continue. At the same time, we are well positioned to capitalize on post-pandemic opportunities as consumers gradually return to pre-pandemic activities that have been disrupted for nearly a year now. Second, we are investing in strengthening and adapting our plans to match the rapidly changing environment we operate in. This ultimately will drive greater brand relevance both at home and abroad, while also ensuring we are delivering on our long-term opportunity to shareholders. We will do this in a thoughtful way to ensure we are prioritizing our initiatives to drive focus and disciplined execution, while also taking a holistic approach to ensure strong bottom line growth. We would now like to open the call for questions. Operator?
At this time, we will be conducting a question and answer session. If you would like to ask a question, please press star one on your telephone keypad. A confirmation tone will indicate that your line is in the question queue. You may press star two if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. One moment, please, while we poll for questions. Our first question is from Sharon Zackfia with William Blair. Please proceed with your question.
Hi, good morning. So a couple of questions for Paul, and they're semi-related, so forgive me, Tom. On the gross margin outlook, I understand the abatement of the product cost improvements. I think you expressed that well, but I'm trying to figure out what else offsets the channel mix benefit if DTC continues to outpace wholesale, which it sounded like that was going to be the case. And then a second, probably easy question is just, what do you view as the right level of leverage for the company? You have very little debt at this point. I mean, when does the board think about returning cash to shareholders?
Hi, Sharon. Good morning. So on gross margin, as we think about it going into 2021 being flat, there is, as we mentioned in the prepared remarks, about reinvesting back into the product. The second piece is while DTC will continue to outpace wholesale, there's two real factors in there, and that is number one, DTC is a higher percent, so every additional mix point gives me less on a channel mix. And then secondly, as we rebuild the wholesale channel inventories, it will be above our long-term guidance where we said wholesale will be mid-single digits. So that's the other factor playing into that. And then lastly, again, as I mentioned in my prepared remarks, the strength of the change in the RMB impacts or comes into factor when we are talking about product cost negotiations going forward as our supply chain team and operations team are talking with our manufacturers. So those are the pieces. And then we talked about the cadence of them, gross margin expanding in the first half of the year. In the third quarter, where we're rolling over a 59.1% gross margin from third quarter of 2020, there being some contraction, and then flat in the fourth quarter. As far as leverage, we've talked about this often. As we think about this holistically. As As use of cash, we're going to continue to pay down debt. We are in a net cash position. We will use cash to rebuild inventory as we go into next year. And, I'll also see with the growth in wholesale, our accounts receivable increase. So we'll use some for net working capital.